Hello, everyone. This is chapters 3 and 4, lecture part 1. There is a part 2, so this is one of two videos for both the chapters. Before going into chapter 3, let's go over an overview of the accounting cycle, or what we've been working on thus far in chapters 1 and 2. First, we analyze transactions. There are business transactions going on, so we have to analyze them to be able to record them. If you recall, this is balancing or ensuring that you're balancing the accounting formula. And the accounting formula is assets equals liabilities plus capital minus dividends plus revenue minus expenses. So just make sure the accounting formula is balanced first of all. Secondly, you want to determine debits and credits using the thought process. Remember that the thought process is what accounts are affected, what are the classifications of those accounts, if they are increasing or decreasing, and finally, are those accounts being debited or credited? This is an important part of the analysis because the accounts being debited or credited is needed so we are able to journalize in the journal. And journalizing in the journal is where you officially record the transaction into the company's records or the company's books. So record which accounts are being debited and credited. And remember, debit comes first, credit comes second. You have a description, and the journal is organized by the date. And that was our chapter write-up that was due yesterday on Sunday, was journalizing business transactions. Next, after journalizing to the journal, we post to the general ledger, or the GL. What you want to do is record each debit and credit from the journal. You're going to go line by line from the journal to the ledger, posting to the general ledger. Remember that the general ledger is organized by the type of account. And the type of account is based on the chart of accounts, where assets comes first, liabilities, your equity accounts or equity classifications such as capital and dividends, then revenue and expenses last. After posting to the general ledger, you create what's called an unadjusted trial balance. I believe in the last video I just called it an adjusted trial balance, but truly it is an unadjusted trial balance. And remember, this trial balance is done or completed to ensure that debits and credits equal one another. It's organized by the type of account, which again, just like the general ledger, is based on the chart of accounts. Now, we are in chapters 3 and 4, and chapter 3 goes over accounting adjustments. So we have to complete these adjustments before we can get to the financial statements. So this is this chapter right here, chapter 3, completing the adjustments. And what you're doing right here is you want to adjust and update account balances. Once again, you want to adjust and update account balances. And once you do that, when you're updating or adjusting, you want to do that into the journal. In other words, you're doing analysis once again on the accounts. You're making adjustments, and when you make these adjustments, you have to journalize them in the journal. And just like normal, and as usual, after journalizing in the journal, you must post to the general ledger or post to the GL. After posting to the general ledger, then you create another trial balance, and this time it's called the adjusted trial balance because you recorded the adjustments for the month or for the accounting period. And after that, then you create the financial statements. That's an overview of the accounting cycle, or what we've done thus far from chapters 1 and 2, and now the adjustments in chapter 3. If my diagram's a little confusing, I've also included another diagram of the accounting cycle. There it is. It's from another publisher. So during the period, you want to analyze transactions. And I know it says chapters 2 and 3 there, but it should say chapters 1 and 2 in our current publisher. You want to record to the journal and then post to the general ledger. Now at the end of the period, which is, again, it should say chapter 3 because we're using a different publisher, we prepare the trial balance, make sure the debits and credits equal, we make our adjustments, then we create our financial statements, and then finally we will do closing entries, which I will discuss in the next video. All right, now let's get into the actual adjustments. Adjustments basically is updating account balances. So we have balances for accounts, but by the end of the period, which is again usually a month in accounting, at the end of the month, at the end of the accounting period, some of the balances are incorrect or not concise. So we have to adjust them. Think about this scenario. Say you had a total of $500 on Monday. Assuming you spent money throughout the week on things like food and gas, how much money would you have by the end of the week? Let's say on a Sunday. Now, if $500 is the only amount of money you had, the answer is you'd have less than $500. You wouldn't say you still had $500. And in fact, that amount has been adjusted. So you have to update your records. And that's what adjustments are. You have to update your records because it's not showing the correct amount. Now I know adjustments can get a little confusing. So try to make it as simple as possible for yourself. Here's a breakdown. Remember that there are two kinds of adjustments. Two kinds. The first kind is called an accrual. So accruals. And the second type of adjustment is referred to as deferrals. So two kinds of adjustments, accruals and deferrals. And each one is broken out by revenue and expense. For example, under accruals, you would have accrued expenses and you would have accrued revenues. So, yes, there's two kinds of adjustments, accruals and deferrals. Under each one, you're going to have an expense and a revenue. And I just said that accruals have accrued expenses and accrued revenues. And for deferrals, it's the same thing. You would refer to it as deferred expenses and deferred revenues. I accidentally wrote accrued revenues there, but I really meant to write deferred revenues. So under deferrals, you have deferred expenses and deferred revenues. Let's go over the difference between accruals and deferrals. Accruals, you enter amounts at the end of the month. So again, you enter amounts at the end of the month that were not existing during the month or during the accounting period. That's important because in comparison, deferrals have existing amounts or amounts that are already there or recorded. And at the end of the month, you have to adjust those amounts because they have changed. Just like our $500 example, where you had $500 worth of money and you spent money throughout the week and now you have to adjust it. Deferrals, again, there's an existing amount in the accounting records. By the end of the month or by the end of the accounting period, you must adjust those amounts because they changed during that time. That is a deferral. Accruals, again, nothing there, but something happened and now you must enter an amount at the end of the month. And deferrals, there's already an existing amount that you just have to adjust because it changed during the accounting period. It's important to know the difference between the two adjustments for you to be able to understand adjustments. I made this chart here. It compares accruals and deferrals. Let's go over it One more time, the difference between accruals and deferrals. Let's start with deferrals. Deferrals, there's an existing amount. That's our timeline up there. So there's an existing amount at the beginning of the month, and at the end of the month, it changes, so we have to adjust that existing amount. So again, there's an existing amount at the beginning of the accounting period. By the end, we have to change it. On the right side there, those are the type of adjustments, deferred revenue and deferred expenses. And I provided examples that the text or textbooks usually use for those type of adjustments. Now, accruals, there's no existing amount at the beginning of the accounting period or beginning of the month. We go through the month, and by the end of the month, we have to enter that amount because something happened during the month that's not part of our accounting records yet, and now we have to enter it. And that is called an accrual. There's your different types of accruals, accrued revenue, and a couple of examples of accrued expenses. Those examples are the ones that the textbooks or publishers usually like to use for their examples, whether it be exercises or problems in the textbook or their online material. I included another chart here from a previous publisher showing the types of adjustments. You have your deferred revenue, accrued revenue, deferred expense, accrued expense. It shows the definitions and also the timeline, just like I did in my chart, in respect to what the adjustments look like and when they happen and why they happen. And that is the overview of adjustments. Now we're going to go over examples of each type of adjustment. So example number one, it is an example of a deferral. A deferral is also referred to as a deferred revenue or unearned revenue. This example, more specifically, is about gift cards. So remember, you're the business and you're issuing gift cards. So remember, a deferral has an original entry. And in this case, here's our example. Beans Schmeans, a local coffee shop, sold gift cards worth $500 on January 1st. So it's at the beginning of the year, and they sold $500 of gift cards. What does that look like? Well, first here's our journal right here. We're gonna put in our date, January 1st. Remember that debits come first and credits come second. And because the coffee shop sold gift cards, they're going to receive cash. So a debit is to cash for $500. And an account called unearned revenue. We're going to indent here. As I was saying, an account called unearned revenue is credited. So unearned revenue. Unearned revenues or revenue is actually a liability account. I know it says the word revenue on there and it doesn't have the word payable, but you got to get used to this account because an unearned revenue account is a liability. Why? The business received cash and now the business owes people coffee or whatever product they may sell in the coffee shop. So unearned revenue is $500. Again, a liability. Now we go to the end of the month and we requires an adjusting entry. $300 worth of gift cards were redeemed by customers and have not been recorded. So once again, the coffee shop sold $500 worth of gift cards. Now they owe the customer. And throughout the month, $300 worth of gift cards were redeemed by the customers. One of the easy things that you can do is create a T account for the account that we're going to adjust. In this case, that account is the unearned revenues account, that liability account. So unearned revenues, we credited that in the original entry, $500. That's the amount that we owe customers in respect to products or services. So let's do our adjusting entry. That's done at the end of the accounting period. In this case, it'll be on January 31st. What you want to do is debit unearned revenues for the amount that was redeemed. In this case, it is $300. And then you're going to credit. So we're going to credit here fees earned for $300. It may not be fees earned, it may be coffee or whatever they may have purchased. Basically, the point there is it is a revenue account. And since the coffee shop provided the service, you have to credit a revenue account. In this case, we're going to use fees earned. Now we're going to record the adjustment in the T account. It's a debit for $300 for unearned revenues. And now the coffee shop only owes customers $200 worth of products or services. So again, there was an existing transaction which involved the unearned revenues account, and you adjust that at the end of the month. Let's go on to the next example. The next example is an example of a deferred expense. It's also referred to as a prepaid expense, so remember that. If you see the word prepaid expense anywhere, that's called deferred expense. Our example in this case deals with the supplies account. Examples of supplies may be paper, pens, staplers, ink for the printer. Those are supplies. So it's a deferral. So remember that deferrals have some sort of original entry that you have to adjust. In this case, LMNOP company purchased $2,000 of supplies on January 1st. So they purchased supplies on January 1st, which is the beginning of the month, the beginning of the accounting period. If they purchase supplies, you want to debit supplies because that asset is increasing. So that's worth $2,000. And we're going to pay cash for it. Since cash is going down, that's an asset. It's going to be credited for the same amount, $2,000. So that's at the beginning of the month. And throughout the month, people are using the papers, the pens, the ink, whatever it may be in respect to supplies. And someone did a count at the end of the month, and you know those supplies aren't going to be the same amount from what you had previously. Now I made another T account, and I'm doing these voiceovers after the fact on these videos, and I realized that instead of putting 2,000, I put 1,000 on the supplies. That should say 2,000 on that T account. So let's keep the example going, and let's just say that the original entry was for $1,000 instead of $2,000. And at the end of the month, my count of supplies at the end revealed there was $200 worth of supplies left. So how do we reflect that in the T account? Well, if there's $200 remaining, you want to put that underneath or below the $1,000. So originally you had $1,000. I know it says 2,000. I made a mistake. Let's assume it's just 1,000. And at the end of the month, you only have $200 left from the 1,000 that you originally purchased. Where I'm pointing here is where the adjusting entry should be, because to reduce what you originally had, which was a debit balance, you have to credit it. So let's do this entry, this adjusting entry, which is considered a deferred expense at the end of the month. Date your adjusting entry, January 31st, the end of the month, the end of the accounting period. You want to debit an account called supplies expense. That supplies expense is for $800. And you want to credit supplies because we're decreasing, again, we're decreasing that account to adjust that amount for $800. So there it is. We're going to put $800 right here. And then now you had supplies worth originally $1,000. You did an adjustment for $800. And your remaining balance is $200. And those are your adjustments. Again, I don't want to confuse you. That $2,000 original entry should say $1,000 of supplies was purchased on January 1st. So it makes sense, meaning the T accounts make sense. Let's go over another example of a deferred expense. Again, it's also called prepaid expense. So if you see that anywhere, it's referring to as a deferred expense. Here's our example, our next one. It is prepaid insurance. So let's assume that this company, Milestone Company, purchased a 2-year prepaid insurance on January 1st. Let's assume that it's a liability insurance. So if anything happens to them, they're covered by insurance. And this insurance is for over 2 years. The insurance is worth $2,400. And again, it covers 2 years. So let's record purchasing the insurance first. So let's date this January 1st. You purchased insurance, and the account you want to use for this is called prepaid insurance. Not just insurance, but it's called prepaid insurance. Because in reality, the company did prepay the insurance. How much? For $2,400. Let's assume that they paid cash for it, so that's your credit. For, again, the same amount, $2,400. We're going to fast forward to the end of the month, and before we do that, let's create a T account for the account that we're going to adjust so we could see it better. So prepaid insurance, currently it has a debit of $2,400 because the company is covered for 2 years for the amount of for the cost, of $2,400. So we fast forward to the end of the month. And at the end of the month, 1 month worth of insurance has expired, meaning the company had 24 months of coverage, right? 24 months, 2 years. But after 1 month, 1 month of insurance is no longer existing because a whole month passed by. So what you want to do is create a calculation first of how much of the insurance expired. Well, it was worth $2,400. 2 years is 24 months, so $2,400 divided by 24 months is insurance worth $100 per month. That's important because the worth of insurance for 1 month is what you're going to adjust the prepaid insurance account for. So January 31st, you want to debit an account called insurance expense. Very similar to supplies. Our previous example, you debited an account called supplies expense. So these entries, you're debiting expenses, or at least these types of adjusting entries. So insurance expense, debit for $100. And then you're going to credit that asset account, the prepaid insurance account, for $100. Because again, we're adjusting that account. It's not worth $2,400 anymore. In fact, it's only worth $2,300 worth of prepaid insurance. The $100 right there is your adjustment. And the $2,300 is your remaining balance for that insurance. Once again, try to make a T account for the account that you're going to adjust. Let's go over one last example here for deferred expense. And our example deals with depreciation of fixed assets. So again, deferred expense, also called prepaid expense, and we're going to go over the depreciation of fixed assets. Fixed assets are assets that are long-term assets. This chapter kind of jumps into it really quickly, but a later chapter will go into it more in detail. So, because it's a deferred adjustment, there is an original entry. Here, Eminence Incorporated purchased equipment for $120,000 with a residual value of $20,000 and an estimated life of 20 years. So the equipment cost $120,000. The residual value is $20,000, meaning that's the estimated amount that it's going to be valued at the end of 20 years. So let's record purchasing the equipment. So your date is January 1st there. And here it is, equipment. And the equipment is worth $120,000. And let's assume that this company purchased it for all cash. That's a lot of cash. So cash will be your credit for $120,000. $120,000. Now, usually I would say that it's the end of the month or the end of the accounting period, but in reality, fixed assets, or in real life, fixed assets are actually depreciated once a year. So here, Eminence Incorporated depreciates its fixed assets once a year. Not once a month, but once a year. So on December 31st, its equipment was depreciated $5,000 for the first year. That means the equipment depreciated or decreased in value, because depreciation means decreased in value by $5,000. It was worth $120,000 and it decreased in value by $5,000. I'm going to make my equipment T account, and from the original entry, it's a debit of $120,000. And now let's record the adjusting entry. Again, this is December 31st and not January 31st. Some textbooks will have you depreciate monthly, but in reality, fixed assets are depreciated once a year. How do I know this? Because I used to do the depreciation in real life. So you want to debit depreciation expense for $5,000. And instead of crediting equipment, or instead of adjusting equipment, this is very key here, you're going to credit what's called accumulated depreciation equipment. Again, you're not going to credit the equipment account. Not. That's very important. Instead, you're going to credit an account called accumulated depreciation on equipment. This account is called a contra asset. Contra means it's a classification that brings down the same type of classification. In this case, it's an asset bringing down another asset. If you notice in the adjusting entry, equipment was not there. So you leave the equipment account alone, and you're always going to reflect that $120,000 for the equipment account. Instead, we're going to credit another account called accumulated depreciation, and you're going to keep it separate. So accumulated depreciation on equipment, we'll do a T account for that, a separate T account, and we're going to credit $5,000. And those are your two accounts, equipment and accumulated depreciation. You take the equipment, which is $120,000, you minus the $5,000 from accumulated depreciation if you want to see what the current value of the equipment is, and that would be $115,000. It's called the net book value of the equipment. So if someone asks what the net book value was, you would say $115,000. Let's explain depreciation really quickly, because again, in the future chapter, the fixed assets chapter, we're going to go over this more in detail. So a quick lesson on depreciation, which we will return to during the fixed assets chapter. We're going to take the exact same example. Eminence Incorporated purchased equipment for $120,000 with a residual value of $20,000 and an estimated life of 20 years. Here's the formula for depreciation. What you want to do is you want to take the cost minus the residual value. The residual value, sometimes it's referred to as the salvage value. It's the same thing. It's the estimated amount that the asset is going to be valued at the end of its life. And you're going to so cost minus residual value divided by useful life in years. That will give you your depreciation expense per year. If a textbook asked depreciation by month, then you would just divide by total months instead of useful life in years. So your cost here is $120,000. Your residual value is at $20,000. And then your useful life in years is 20 years. And that's how we got the $5,000 for our adjusting entry. So 120,000 minus 20,000 divided by 20 years, then that will give you the $5,000 depreciation per year, which we used in our example. This is actually called straight line depreciation. But again, in this chapter, you don't really need to know that in detail, because we will go over that, or depreciation and types of depreciation, in future chapters. So there's that $5,000. That's how we calculated that amount from the given information. Now let's go over accruals. And remember, there's two types of accruals: accrued revenue and accrued expense. In this case, or in this example, let's go over an example of accrued revenue. And our example deals with interest from investments. So we made some investments, or the company made some investments, and interest was earned on those investments, but we haven't received it yet. Do we have an original entry? None, because accruals do not have original entries. What happened, or something did happen during the accounting period or during the month. In this case, we earned interest from an investment, or the company did, and now we have to create an adjusting entry. So as of the end of the month, Highlands Company earned $2,500 worth of interest from investments. Here we're going to date the journal entry. Let's say it's January 31st. What you want to do is debit an account called interest receivables. So interest receivables, very similar to accounts receivables, but we're not expecting money from customers because of products and services we provided or the company provided. Instead, we're expecting to receive payment in the form of interest from investments that the company made. So that is interest receivables. You're expecting that payment to come in the future for $2,500. And next, you want to credit interest revenue because it is revenue. You're recording revenue because you earned some sort of interest. So again, debit interest receivables, which is an asset. You're receiving, or you're expecting that interest payment in the future, and then you want to credit interest revenue. Our next example is an example of an accrued expense. Remember, accruals. There's accrued revenues and accrued expense. So now we're going to go over an accrued expense example. In this case, it is wage expense. Wages are the payments made to employees for their work. Is there an original entry? No, because that's a main distinguishing factor between a deferral and an accrual. Deferrals have original entries and accruals do not, and this is an accrued expense. What is our adjusting entry stemming from? Well, here's our example. Vaqueros Company pays its employees $25,000 per week on Friday. This is based on a 5-day work week. The end of the month ends on a Wednesday. Wages earned from Monday through Wednesday are recorded. So, the employees worked a full week, Monday through Friday. But the end of the month, or the end of the accounting period, ends on a Wednesday. So we have to record that expense, the business's expense. In this case, it's the wages that are going to be paid to the employees from Monday through Wednesday. The problem is you don't pay them until Friday. So the point here is you want to record the expense, the Monday through Wednesday expense, in the current month. What you want to do first is calculate how much per day the employees are getting paid. So $25,000 per the week divided by 5 days equals $5,000 worth of wages per day. So we have Monday, Tuesday, Wednesday left for the accounting period. So that's 3 days times $5,000 per day. And that will give you $15,000 worth of wages that were worked in the remaining days of the accounting period, which is Monday, Tuesday, Wednesday. Thursday, Friday, that's the new accounting period or the new month, and that belongs in the next month. This is key because we're making an adjusting entry because we have to record the expense in the current month, which is January, because Monday, Tuesday, Wednesday is still considered January. So January 31st, what you want to do is debit wage expense for the $15,000. And then you owe the employees this money because you're not going to pay them, or the company's not going to pay them on a Wednesday. They make their payments on Fridays. So what you want to credit is wages payable because the company owes the employees that money, $15,000. Once again, debit wage expense and credit wage payable for the amount that belongs in the accounting period, which is Monday, Tuesday, Wednesday. Let's go to our next example, and the next example deals with utilities expense. So utilities is things like electricity and things of that nature that a business needs to pay for um, in the course of its operations. Does it require an original entry, or was there an original entry recorded? None. There is no original entry. That's why it's an accrual, because you're not adjusting an amount that's already there. In fact, the company was using up the utilities throughout the month, and that's why we have to record this adjusting entry. Here's our example. Gaucho's company received a utility bill for $700 on the last day of the month. They will pay it next month, and the bill is recorded. Just because the company's paying it next month doesn't mean that they should record the expense the next month. What you have to do, because it belongs to January, is you have to record the expense in January. And that's why the adjusting entry is required. So on January 31st, you want to debit utility expense for $700. And then you're going to credit utilities payable for $700. Usually it's the name of the company, whoever the business is paying or going to pay in the future, it's that company's name and the word payable. But we'll just call it utility payable for $700. The point there is the company owes for utilities to another company that provides those utilities. All right, let's go to another accrued expense example. In this case, it is interest expense. So here's our example for accrued expense, and it deals with interest expense. Do we have an original entry that we need to adjust? No. I'm trying to drive home this point that accruals do not have original entries, deferrals do. Remember, two types of adjusting entries. So no original entry that we have to adjust. And what's happening here is the business probably took out a loan and they have to pay some sort of interest that they have not paid out yet. So here's this example. As of the end of the month, Delos Reyes Incorporated owes $1,500 worth of interest. It will be paid next month. But that interest that they incurred is for January, so you have to record that expense for January. So the date is January 31st. Interest expense is your debit, and the interest expense is $1,500. And because you have not paid it yet, or the business has not paid it yet, it's going to be a payable because they owe that amount. So interest payable of $1,500. It's very similar to the utilities adjustment because it's the same. You debit an expense and you credit a liability. In this case, it's interest expense debit and credit interest payable because the company still owes that and is planning to pay it next month in February and not in January. Okay, so we went over many types of examples of adjusting entries. I'm going to include a summary of the adjustment process. So summary of the adjustment process. This is a chart from a previous publisher. It shows the same thing that we went over. Let's go over the expense side first. When expense is incurred means when an expense happens, that is a deferred expense. And you have an accrued expense on the flip side. So deferred expense and accrued expense. And then on the other side, we have deferred revenue and accrued revenue. For deferred revenue and accrued revenue, those are the journal entries. For deferred expense and accrued expense, those are your journal entries, what they should look like. It just gives you an outline and an example just to make things clear on what the journal entries should be looking like.